Hey guys, welcome or welcome back. My name is Felita and this is Budgeting with the Mealings. In today's video, I will be discussing the 3 most important steps in becoming a homeowner. If you or someone you know is considering purchasing a home within the next 6 months to a year, then this video is for you. So stay tuned. The first step in purchasing a home is finding a loan officer that you trust and that you know is going to be looking out for your best interest. A loan officer that knows the lending world. So you're probably going to be asking, why would I consult a loan officer first? Well, a loan officer can pull your credit report for free. They can tell you what derogatory items you have on your credit report, and they can also tell you what things you're doing that's working in your favor. The 3 credit reporting agencies are TransUnion, Equifax, and Experian. And all 3 of these credit agencies house your actual FICO score. Now, for the purposes of this video, when I say credit score, I'm referring to your actual FICO score, which is the score that will be pulled from those 3 credit agencies. A lot of times people use FICO score and Vantage score interchangeably, but those are actually 2 different things. Your FICO score, as I stated before, is the actual score that is used, and it's based on how you've paid your bills previously, whether it's credit cards or car loans or student loans, or maybe if you had a furniture bill. That FICO score is composed of all of those things, whereas your Vantage score is primarily a consumer-faced reporting agency, and that particular score is based on that particular, just say, credit card. If you know, when we go out and we check our score and it's on our credit card, that's considered a Vantage score. So that's more of a consumer facing score. So, and that is not what they use when they're looking at whether or not you can purchase a home. So anyway, for the purposes of this video, when I say credit score, I mean FICO score, and those are the scores that are pulled from those 3 credit agencies. Now, you can actually get a copy of your, instead of going to a lender, you can pull your credit report yourself. You can go to either of those credit agencies, or you can actually go to myannualcreditreport.com and you can pull your credit report there. The only difference is, number one, you won't have the expertise of an actual loan officer to tell you what is considered derogatory, nor will you have your actual credit score attached to those particular reports. Now, lastly, we all know the higher your score, the lower your interest rate that you'll receive. Now, most lenders, they would like to see at least a 720 for a conventional loan and at least a 580 or higher for a FHA loan. Now, that's several loans that you may want to consider. There's VA loans, which come from the Department of Veteran Affairs. Now, those are for active or former service members and their eligible spouses. VA purchases, they allow you to actually get a mortgage with no down payment. Now, there are jumbo loans, which are mortgages for homes that are very expensive, and they're really not standard. Usually they require a larger down payment and you have to have a much higher credit score. There's also renovation loans, and they let you wrap the cost of the repairs of the home into the total cost of the loan. Okay, there's also conventional loans and FHA loans. Now, we'll be addressing mostly conventional loans and FHA loans today because those are the most common loans that most first-time home buyers will actually be qualified for. What is FHA and what is conventional, and what's the difference in the 2? So conventional loans require a minimum down payment of 5 to 20%. You need to have a credit score of at least a 620, and a minimum debt to income ratio is 43%. Now, there are advantages to having a conventional loan. Conventional loans don't require mortgage insurance as long as you pay that 20% down. conventional loans can cover higher loan amounts than FHA loans, which are restricted to whatever your county limits are. Conventional loans on average are processed faster than FHA loans, which is also a plus. So say for instance, you have a household income, take home income of about $5,000 per month. That would mean you could spend $2,150 per month on mortgage and other debt. Now to do the math on that, it just say for instance, if you had, and I'll just put my calculator here for you guys. I hope you can see that. Whatever your income is, and for the purposes of this video, we'll just use the $5,000. You have $5,000. I don't know if you can see that. And then you just multiply the 43%, which is the debt to income ratio that the conventional loans require that you have. And that's where we get the $2,150 from. So you just take whatever your income is and you multiply it by the 43%, and that should give you what the requirement is for that particular loan. Now, there's also FHA loans, and the FHA loan requirements are a little bit less. Down payments, you only need 3.5%. You need to have a minimum credit score of at least a 580. And then the maximum debt to income ratio is 50%. So you can see that it's a little bit more lenient for these types of loans. But the requirement process is a little bit lengthier as well. Now, FHA loans do have a lower down payment requirement of the 3.5, which is less than the typical 5% to 20% of a conventional loan. And that's where a lot of people fall. You know, if you're buying a $200,000 house, you may not have the 20% to put down on that home. So a lot of people fall into that FHA category. FHA loans have lower credit score requirements, like as I stated before, a 580. I think that is the lowest that they'll even accept for an FHA loan. And then also with FHA loans, they have a less stringent DTI, which is a debt to income ratio. It's 50%. So again, you just take your monthly take home pay, just say $5,000, and you multiply the $5,000 times 50%, which will give you $2,500. So that's the most that you would be allowed as far as this FHA loan is concerned to pay as far as your debt repayment. So there's a huge difference in the two as far as, and really the main differences in the two is the debt to income ratio and the minimum down payment amount. Say for instance, you don't have the 20% to pay down on a home, which most of us don't. We don't have, you know, $20,000, $30,000 just laying around to pay on a home. So in that case, for your loan, you're going to be required to have private mortgage insurance. And in the home buying world, that's considered PMI. Now, PMI is an insurance policy that is required on all conventional loans when at least 20% is not paid down at closing. And you're required to keep that insurance and pay that additional amount until you reach at least 20% paid on the life of, or on that particular loan. Now the PMI ranges from about 0.3% to 1.15% of your home loan. So depending on the cost of the total cost of your loan, and they do look at other things like your credit score, they look at the debt that may be showing on your credit report at the time of closing. So they look at those type things to determine what amount. Basically, they're trying to see what type of credit risk you are. Are you more likely to default on that loan? So the higher the risk, the higher that percentage. And the lower the risk, of course, the lower the percentage. So they take all of those things into consideration, and your PMI will be either 0.3% up to 1.15% of the total cost of the loan. Now, lenders generally recommend that people look for homes that cost no more than 3 to 5 times their annual household income. to make up that 20% down payment. And then they also would like to see that you have moderate debt. And I can distinctly remember purchasing my first home, and they didn't want any debt. So when I closed on my house, I had like no credit card debt. I had no student loan. I had no car payments. I mean, I had nothing. And it's so funny because I guess maybe a couple of weeks prior to me even closing on the house, I'd had a gas card, and I went to get gas because I was trying to build my credit. And I went and I swiped, and I think it was like maybe $25, $30. And my loan officer called me and said, "Hey, you have a charge. It's $25. You need to have that paid before we go to closing." So they look at every little bitty thing that you do when it comes to buying a home. So you have to be extremely careful, and you have to have a loan officer that knows what they're looking for. So, the national median family income for the United States for the fiscal year of 2021 is $79,900, and it actually increased over the national median income in 2020, which was $78,500. So, I'll just give you an example of what it would be, or what your mortgage would be if you paid 20% as opposed to not paying 20%. And you can actually find these mortgage calculators everywhere. Just Google mortgage calculators and it'll pop up. And you can just input and kind of play with the numbers, which I actually recommend that you do, so you won't be blindsided when you go in and sit down with a lender and try to determine, what it is that you're looking for. Now, step two is to figure out how much house you can afford. Now, how much house you can afford is not the same thing as how much you qualify for. Now, to do this, you must, and I repeat, you must have a budget. Your budget will tell you how much you can comfortably afford to pay on a home mortgage every month. Housing expenses shouldn't exceed 28%, and this is based on loan to income value. but it should not exceed 28% of your monthly income. Some lenders do go as high as 30%, although I would not push it. But you and I both know that there are other things to consider when you're looking. It's not just your mortgage and your income. You know, for us, we have other things like our kids' extracurricular activities. I know for me personally, I have two daughters that was in competitive cheer, and I was paying upwards of $500 a month on just them being in cheer. And if they wanted to do privates, that was an additional fee. Well, when I went to get my mortgage, they didn't consider that. They didn't care if my children did cheer, and I'm sure that you guys have children that are in other sports, volleyball, soccer, baseball, football, and those things come with expenses, and we need to, in addition to our mortgage and utilities, we need to consider those type things. If you're the type that want to get your hair done every 2 weeks, or haircuts, or you may want to have a cup of coffee or a glass of wine with a friend, if you have that in your budget, then you know you're spending X amount of dollars every month, so you can comfortably put that into your budget. Or if you're one that vacations, or you have a certain amount set aside that you want to spend every month, or I'm sorry, every year for Christmas, or you have maintenance currently on a home, or on a car, or you have medical issues or medical bills or prescriptions, and these are things that when your loan goes to underwriting, they're not looking at those things. They're just looking at, you made X amount of dollars and you want to buy this home that costs X amount of dollars. They're going to do the math on those two things, and that is it. So you definitely do not want to be house poor. You pay so much money on your home that you can't afford to do those things that really mean the most to you, like have your children in extracurricular activities, or go on vacation, or even, provide a really nice Christmas for them. Even though we do know that Christmas is not about just the gifts that you receive, but it is nice when you can give your family and your friends that little extra at the end of the year. So step number 3. Find a real estate agent that you trust and that you like. Just like the loan officer, a real estate agent will be able to provide you with like market insight. They'll be able to give you insight on what to offer on a home. They'll be able to negotiate. They know the different markets. They know what's going on in different areas of your town, and then they can even give you professional recommendations. And what I mean by professional recommendations is everyone is not going to be in a position to buy a brand new home. You may get a pre-owned home, walk in, love the home, but hate the paint. So your real estate agent may be able to say, hey, I know a guy that can, paint your home for little or nothing, or, for whatever the price may be, give them a call. So they have built this Rolodex of people that can assist with those type things. So just the experience of a real estate agent is, you really do need to have that. And I would always recommend that for a first-time home buyer. One of the first questions that a real estate agent may ask you, and that's if you have been pre-qualified, which is one of the reasons why I say, hey, get with the lender first. Let them tell you what you can afford, what's on your credit, and then you'll know whether or not you can go through some of these other steps. Now, they're going to ask you if you've been pre-qualified for a couple of reasons. The first reason is because they don't want to start taking you to see $500,000 homes, but you can only afford a $125,000 home. And then secondly, and I must admit that I did this one myself when we got ready to sell our previous home. I made it it was a contingency that anybody that came to view our home, they had to show pre-qualification for the purchase price of our home. And the reason that I did that, and the reason that a lot of sellers are doing that, is because you have a lot of the looky-loos, the people that just want to come and look around and just see what you have, and they're really not in the market to buy a home. But for me, I just had our last son, our only son, but I just had him. He was maybe 6 months old, and it was really a pain to try to, make sure the house was immaculate each time we had a viewing. So to cut down on the people coming into the home that really had no desire to purchase the home, really, I made that one of the contingencies, and a lot of sellers are going to that. So don't be offended if they ask you if you're already pre-qualified and for what amount, because if that real estate agent is really on your side, they're doing it to help you, and it's also helping themselves. And then the other reason why I tell you need to find a real estate agent that you really like is because you don't want to be walking around or riding around with a person that's always late. You've been waiting on them for 30 minutes to an hour, and then they get there as if your time is not valuable, or they're taking you to see things that they know that you don't like. So you looking at them crazy. And so you want to have some type of relationship with your real estate agent to where they're only taking you to see properties that you know potentially that you'll purchase. So that's one of the other really big things. I do have a couple of bonus tips. Many first-time home buyers programs, they offer like a minimum down payment, which is as low as 3% to 5% versus the standard 20% that most of the loans are going to ask you for. But you have to go through certain agencies. So I know that HUD has a resource list. Although the government agency itself does not make any grants to individuals, they do have certain agencies that they will give funding to if you go through that particular agency's programs. So what I mean by that, I know here in our area there is a first-time home buyers class. If you go through that home buyers class, then they apply a certain amount. I know at one time it was $1,500. It went up to, as much as $3,000. So it depends on the amount of funding that they have and if they're offering the class. But I will have the HUD link listed below for you to go and check that out. But that it is a great resource, and it helps. Any little bit that you can get to go towards the cost of your home, that helps out. And these are grants. These are not loans, so this is money that you do not have to pay back. Now, the second thing is your IRA. Every first-time home buyer can withdraw up to $10,000 out of their traditional individual retirement account, which is your IRA, or your Roth IRA, without paying a 10% penalty for early withdrawal. But you still have to pay taxes if you use like a traditional IRA. Now, what that basically means that if you're a couple and you're wanting to purchase a home, each spouse can take out $10,000. So that's a total of $20,000. And for the majority of us, the $20,000 will be more than enough to cover the down payment. The only downside to that is if you don't repay the money within the first 120 days and you're under the age 59 and a half, then you are liable for a 10% penalty. But if you think about it, if you get $20,000, you pay 10%, that's only $2,000, which is a lot less than having, and then that's also filed on your, it has to be filed on your income tax. You'll get a 1099 if I'm not mistaken. And you'll have to file it on your taxes. But the $2,000 is a lot less than having to come up with $20,000. So that is an option for a lot of people. Now, in different states, they have different programs. I know in the state of Illinois, Ohio, and Washington, they offer financial assistance with down payment and closing costs, as well as with expenses to rehab or to improve a property for first-time home buyers who actually qualify. So that you have to look into your state to see what programs are available. So in addition to maybe getting the, HUD assistance, you may also qualify for some type of state assistance. So that's also another option. And then lastly, there's also the Native American option. I don't really know a lot about the Native American option, but Native American home buyers can apply for a Section 184 loan. Now, this loan requires a 1.5% upfront guaranteed fee and a 2.25% down payment on the loan that's over $50,000. And if you think about it, that's like almost nothing compared to if you went to get a conventional or an FHA loan. So that's called a Section 184 loan. And again, that information will be linked below. Now, the second bonus tip that I do have for you guys is to always get an inspection on your home. It does not matter whether the home is new. It does not matter whether it is a pre-owned home. And do not listen to your real estate agent or the seller of the home. If they say, oh, well, it looks nice and you don't need it, you need it. Now, with an inspection, tip in my area, I know they're going for around $400, but that will be the best $400 you have ever spent. Now, typically that expense for the inspection is non-refundable, but it helps you out and it gives you a peace of mind. And I'll give you a real life example. My husband and I went to look at a home, and the home was immaculate. We loved the home. I mean, we could not find one single thing wrong with the home. The inspector came out, he got up on the roof, and he found that there were several layers of shingles, which meant that the home needed a new roof. So I know those are things that, I'm not going to get up on a roof and check. I'm not going to crawl, in the crawl space to see, if there's leaking water. So these are things that an inspection could potentially, or an inspector could potentially find. So I always recommend that you get a home inspection. Just put that money aside, $400 or $500, and trust me, that's the best $400 or $500 you will ever spend. Some other things that I did want to mention to you guys it was actually information that was given to my husband and myself when we got ready to purchase our first home together. And it came from my loan officer. And I'll actually have his information below because he was great. When I tell you he has a 98.1% close rate. So what that means is that if you sit in his chair, he is 98.1%. There's a 98.1% chance that he can close the loan for you. And that is phenomenal. Now, some of the things that he told us, if you have student loans, consider not consolidating, but doing some type of income-based repayment plan. So instead of the underwriter, which is the person that actually look at all your documentation and determine whether or not you qualify for the loan, what they'll do, instead of looking at your total student loan, you may owe $50,000 or $60,000. They'll only look at what you're required to pay. So like, say for instance, for me, when I went and we applied for a loan, I had about $40,000 of student loan. And when they look at each individual loan, because typically your student loans are broken into loan 1, 2, 3, 4, A, B, C, D, or however they choose to break them up. And each loan has a money amount attached to it. Well, your underwriter is looking at each one of those as a completely separate debt. When you get it put into an income payment or income-based repayment plan, it is then considered one loan as one payment. So that cuts down on your debt to income ratio dramatically. So I would also recommend that you do that, and also talk to your loan officer about that. I would recommend you talk to my loan officer about that. I did let him know that I would be sharing his information today. I'm not sure where you guys are located or if he'll be able to assist you. Maybe he'll be able to give you some pointers or direct you in the right on the right path. I am not being compensated or anything for this, but I do think that it's so important for you to have somebody on your side that is really working for you. And he did that, for us. One other thing that he did tell us was our credit cards. A lot of times you think, oh, I need to build my credit, and you go out and you start charging things, and your income to debt ratio then becomes too high. Not because you are charging things, but a lot of people don't know that you don't need to utilize more than 30% of your income, or I'm sorry, not your income, 30% of the credit card that you, or whatever that credit card is. You don't use more than 30% of that. Now, some of these tips I'll actually be discussing in my credit restoration or credit, try to get your credit up, but we'll be discussing that then. But that's another tip that he gave. But he just kind of went through our whole credit report with us, and to say, okay, well, do this, make sure your credit cards are at this amount, for each individual credit card, don't have it over this amount. So those were tips, and it actually raised our credit score dramatically. I also have some other tips too. It's in a video that's upcoming, as far as like credit repair and how to raise your credit score. But those are some things that he went over with us that helped us out. But just remember that, the first step, find a lender. Let him look at your information, or her, and let them determine what you need to do, what you need to change, and then you can kind of get him, he can, or she can give you an idea of what you'll be able to afford. Like I said, that would be one of the first things that you would need to do. And then, figure out exactly how much home you can afford. No one wants to be house poor. You definitely want to be able to make your mortgage payment comfortably and still be able to have some form of, some standard of living, to be able to, go on vacation and have your children in different activities and what have you. And then lastly, find a real estate agent that you like, and somebody that you trust, and that's not going to try to get you to purchase a home that's more than what you can really afford, because they want to get some type of, commission off of the home. So those would be my three main steps. And then, of course, look at the links below, you can go over, go to some of those sites and see if you qualify for any of those grants, first-time homeowners programs. And one other thing, just because you've purchased a home previously, like my husband and myself, when my husband and I first met, I'd already purchased a home. We sold that home and we moved. Of course, we started looking for a new home because our family had grown. Well, we were under the impression that we would not qualify for the first-time home buyers program because I had previously purchased a home. But unbeknownst to us, after a certain amount of time, and when we made our second home purchase, the requirement was 3 years. So it had been 3 years from the time that I originally purchased the first home until the time that we got ready to purchase the second home. So those are some of the things that a really good lender will let you know and be able to navigate for you. So, but anyway, check out the links below. If you have any questions, please do not hesitate to reach out. This is really all that I have for this particular video. All of the links to the information that I've discussed will be listed in the description box below. I can provide actually a written copy of all of the information with the links from today's video. So please feel free to leave a comment below with your request. Also, like I stated before, next week we will be discussing credit repair and ways to raise your credit score, especially if you're in the market to purchase a home or either to make a big purchase. You always want to have your credit score as high as possible so that you can get the lowest interest rate possible. If you have enjoyed this video, please consider subscribing, hit the like button, and leave a comment below. And thank you guys so much for watching. Bye-bye.